Welcome back to Bull Street, and today we're going to be looking at the company New Residential Investment Corp, ticker symbol NRZ. This company is a real estate company dealing with mortgages and properties. They also deal with insurance. They're diversified in many different aspects of real estate. The current PE ratio of the company is 7.85. This is good. And you typically want to see a PE ratio below 20, and the average PE ratio of the S&P 500 is 34.95. This means that this company is substantially lower than the S&P 500 PE ratio. However, we want to look at the average PE ratio for this stock. Some stocks never trade at too high of a PE ratio. So by looking at the historical average, we can see if 7.85 is a fair value. We can see that this company has previously reached 20 PE ratio and has gone down as far as 4 within the past 5 years. 7 seems to be around the average. One very attractive aspect to this company seems to be the dividend yield. This is one of the first things that people will notice about this stock. It has an 8.25% dividend yield, paying around, at the current moment, 20 cents per quarter. However, we don't want to be fooled by the dividend yield. We want to make sure that the company can pay the dividend yield effectively. We look at free cash flow to ensure that the company can pay off their dividend consecutively. The current free cash flow as of June 30th is negative $515 million. This means that the dividend might not be secure and we might be seeing a dividend cut in the future. And if we don't see a dividend cut, there could be potential losses and growth of the company. We also want to analyze if the company has been growing their dividend or if they cut their dividend. We can see that the company has been growing their dividend from 2015 up until 2020. In 2020, when coronavirus happened, they cut their dividend from 50 cents to only 5 cents. From April 2020, they grew that dividend from 5 cents to 20 cents. They have been paying 20 cents for the last 3 quarters. This means that it's likely for the next couple quarters that they're going to be paying a 20-cent dividend, and it is also likely that they could rebound their dividend back into a higher number than 20 cents. Next, we want to look at revenue growth. We can see from 2017 to 2020, they have consecutively been losing revenue each year. The only outlier is within this current year, where they have actually grown revenue. The concern here is, can they maintain the revenue growth that they've had in this current year? Next, we want to find something called the current ratio. This ratio will help determine if they can cover all their debts with the current assets on hand. We do this by subtracting total assets with total liabilities. Their total assets is $37 million and their total liabilities is around $31 million. This means that if they covered all their liabilities, they would still have around $6 million in assets. This is a very good thing for a company to have. With the current price of the stock, we've seen a significant rise today, with after-hours trading going from $9.87 all the way up to $10.37. This is around a 50-cent jump. Looking at the one-year chart, we can see lows of $7.40 and peaks at around $11.30. We know that the price right now is at around $10.37, which is making the price above average for the current year. Looking at a 5-year chart, we can see a very different story. We can see that before coronavirus, the stock was trading at $17 to at lows of $14, making this at least $5 less than what it was pre-COVID. Comparing this company with the S&P 500, we can see that within the past 5 years, the S&P 500 grew 105%, while this company has declined around 30%. If you were invested for 5 years, because of the dividends, you likely would have sustained your money at around a 0% gain. Whereas the S&P 500, you would have been over 105% with dividends. So the S&P 500 has outperformed this stock within the past 5 years. We can also see that this stock has dropped more in the 2020 recession, meaning that the durability of this stock during a recession might not be well. So if a recession happens again, this stock could tumble much harder than the S&P 500. Now I have this spreadsheet here to help determine how much money we would make throughout the following times, depending on where the share price moves. If the share price goes back down to what it was previously today, you would still be looking at a gain within 1 year of about 2.7% with dividends. This chart does not include dividends reinvested, so if you reinvest your dividends, you're likely to have an even larger gain. The share price would have to drop below $9.58 for you to lose money within the next year. If the share price recovered back to a $15, we would see a 52% gain within 1 year or a 60% gain if it happens within 2 years. So if you think the stock will recover within 1 or 2 years of a $15 price, you're going to be looking at a high gain, which is likely to outperform the S&P 500. I hope you guys enjoyed this video. Please comment which company you would like to see next, and please like, comment, and subscribe. Thank you guys for watching.